Chapter 11, Cash Flow Statement, Part 2. Now we're going to prepare a cash flow statement using the indirect method, which is number 3 on our presentation. Now the indirect method is we reconcile from net income to cash provided by operations. The direct method, we report all cash receipts and cash payments, and we'll do that in Part 3. Regardless whichever method you use, indirect or direct, and remember this only applies to operating activities, investing and finance are done both the same, you're always going to get the same answer. So let's take a look at the method. Now, in order to do it, first you need the income statement, and you need to find the net income, any depreciation, depletion, or amortization, gain or losses. And on the balance sheet, for operating activities, you need to look at the changes of current assets and current liabilities. Now, how do these changes affect the cash flow from operating activities? Indirect method. Depreciation we add back in, losses we add back in, gains we subtract out, increases in current assets are subtracted out, decreases are added in because there's an inverse relationship. Increases in current liabilities are added in, decreases are subtracted because they go in the same direction as the change in the account. And that's how we get net cash provided by operating activities. So, a company's income statement showed the following. Net income, that would be an increase. Depreciation expense, that would increase. Gain on sale, we'd have to subtract that out. Now let's look at the balance sheet accounts. Accounts receivable decrease, that would increase our cash flow. Merchandise inventory increased, that would decrease our cash flow. Prepaid expenses decreased, we'd have to increase our cash flow. Accounts payable increased, it increases our cash flow. We now can calculate cash provided or used by operating activities. So again, depreciation is added in, gain is subtracted out, accounts receivable is added in, merchandise inventory increase is backed out, prepaid expenses decrease is taken out, added back in, Increase in accounts payable is added back in, and we add all those up, and now we have our cash flow from operating activities. Now let's look at investing activities. Investing and financing are both a lot easier. So if we sell a long-term asset or we buy it, it reduces it. If we collect on a note, it's going to increase it. If we loan, it's going to decrease it. And that's how you get our net cash. Now the only item that you might have to do some work on is they'll normally show plant assets net, which means they're including accumulated depreciation. So remember, it has a beginning balance. We subtract depreciation expense. We're going to have to look at the income statement. Then we're going to see, have there been any acquisitions or any assets sold? And that'll give us our ending balance. So let's look at an example. In this case, a machine with a cost of $130 accumulated $85,000 for accumulated depreciation, and they had a gain. So where's the cash? I like to do the journal entries. I take the accumulated depreciation off the books. I take the equipment off the books. I show the gain. I add up the equipment and the gain, and that tells me I got cash of $65,000, which is going to show under investing activities on the cash flow statement under. So now we're going to go through all of these items, and we're going to see if we can do investing activities. First, we're going to determine accumulated depreciation, and then we're going to do our journal to figure out our cash. This is just how I do it. You can do it any way you want. Okay, that tells us our cash generated. We know we paid $49,000 for the truck, so that's going to reduce. We used it. Sold land, they told us how much cash we got. So that's going to generate it. We purchased treasury stock. We don't care because that's financing activity. And we had long-term stock we purchased that would use cash. So This is what your cash flow statement would look like from investing activities. Now we'll go to financing activities. If we issue stock, we're going to get cash. If we buy back our own stock, it's going to use our cash. If we borrow, we're going to get money. If we pay back, we're going to lose money. If we pay dividends, we're going to lose cash. And that gives us net cash used financing activities. So let's look at an example. So net income would be operations. We don't care about that. Sold stock, that would increase our cash for financing activity. Paid dividends would decrease it. Paid bonds would decrease it. Purchased equipment, we don't care. That's investing activities. Paid $20,000 in interest. Remember, anything involving interest is part of operating activities. So our cash flow from financing activities would look like this. Now let's prepare an actual cash flow statement using all three parts. Now, this is a slide you should print out because I tell you what you need and what you're going to do with it. So first, you're going to look for the income and you're going to add that in or take it out if it's a loss. You're going to look for depreciation or amortization. You're going to look for any gains or losses. That's going to be the income statement, and you're going to use all of that as part of operating activities. Then on the balance sheet, you're going to figure out what's the total change in cash because that's what your operating, investing, and financing activities must total. It's a check number. Determine the changes in each account on the balance sheet. Remember, you have to explain every change. You're going to determine if each change is part of operations, which is current assets and liabilities. Investing is long-term assets or financing, long-term debt and stock activity. Then you're going to determine what effect each change has on the cash flow. Remember, current assets have an inverse relationship. Analyze the net equipment account to determine cash purchases or sales and retained earnings to determine if any dividends were paid. Now, if you follow this, you should be able to easily do a cash flow statement. So now let's first look at our income statement. Here it is. First, we want to look at the net income because that's going to increase operations. But remember, that's going to be included in trying to determine dividends. So we need that number. Depreciation, it's going to increase operations, but it's going to affect net equipment. So we need that number to figure out if we bought or sold any equipment. Now we'll look at our balance sheet. We have 2 years. This is the number we're going to try to total to, which is the 9,100. Now we're going to go through our current assets and current liabilities. Our accounts receivable went down, so it's going to increase operations. Our inventory went down, so it's going to increase operations. Our accounts payable went up, and they go in the same direction. It's going to increase. Accrued liabilities went down, so it's going to decrease. Now we'll go to investing activity. Our land went up, so that's going to decrease investing. PP&E, we have to first analyze to determine the cash, whether we bought or sold equipment. We'll do that on the next slide. Then we're going to look at notes payable. It increased, so that is going to increase our cash under financing activities along with our stock, but we can't determine anything. We have to look at the retained earnings balance to determine if dividends were paid. So we have to analyze retained earnings and fixed assets net. So first, we're going to look at fixed assets. We're going to show what does the balance sheet change show us. We started with 196.5, we ended with 188.1, and we wrote off, we depreciated 25,200. So now what we have to figure out is how much did we buy or sell? And it looks like we bought. So what we're going to do is we know that the ending balance equals 196.5 minus 25.2 plus purchases. We're going to put them to the other side, and then we're going to subtract, take the 188 minus the 196 plus the 125, and that's going to tell us we had 16.8 in purchases of new equipment. Now, here's what you should always do. Next, take the 196.5 minus the 25.2 plus the 16.8 and make sure that equals 188,100. Then you know your answer is correct. You always want to check. Now we're going to look at the dividends. This is what it looked like. We had a beginning balance of 154.8. We had net income of 137.5, and we had an ending balance of 48.7, which means we did pay dividends. And we ended up paying 143.6. Now again, you want to add the 54.8, the 137.5 minus the 143.6 and make sure you get the 48.7. These are the amounts that are going to appear on the cash flow statement. The purchase of the equipment would be investing. The dividends would be a reduction under financing. So now let's take a look at that cash flow statement. This is what it would look like. This is based on a review of net equipment, and this is based on a review of retained earnings. And if you notice, that ending balance does tie to our ending cash balance.